When the episode is done, don't forget to join our Telegram, the Analysis in Chains Telegram, where we're not faking all of the messages and transactions.
This is the Analysis in Chains with Nathan Williams and Neil Kieran.
Welcome to Analysis in Chains. I'm Nathan Williams. Neil, how are you holding out? Is the spring arrived yet in Montreal?
Yeah, Nathan, it's coming. The snow and the ice is starting to melt a bit like crypto markets at the moment. So cannot wait to finally get out there and start living life again.
It's true. There's been a lot of interest in crypto recently, and almost like a resurgence of a spring-like feeling. However, there's also been a bit of a scandal. Have you been following the trading volume scandal?
I have. It kind of reminds me of what we discussed a few weeks ago, where we were saying that a lot of the transaction volume was faked. Well, I wouldn't say faked, but a lot of extra transactions that were related to exchanging hands of Bitcoin. In this case, it would appear that a lot of trading volume is faked or doubled up, or some fake transaction volume is created in order to seem or make it out that Bitcoin is being traded more than usual. Because when we look at the trading volume of today and the price of where Bitcoin is, it doesn't make sense when compared to 2 months ago, 3 months ago, 4 months ago. It's almost like Bitcoin should be trading at $15,000 compared to the amount of trading volume we're seeing at the moment. So there's a lot of articles going around that this trading volume is faked. But what is actually interesting is that it seems to have peaked at the same time. So for the last 2 or 3 months, we've seen trading volume, quite flat. And I think this is why a lot of people are still on the sidelines. So even if you were to take this whole trading volume with a pinch of salt, a lot of people are still waiting for trading volume to drop, and with that price of Bitcoin drop before they start to get back into the game again.
One of the things to keep in mind is that it doesn't necessarily mean that there is coordinated attempts to defraud the entire industry. It might be something as innocuous as a bunch of exchanges innocently trying to defraud individuals themselves. Because when we're talking about trading volume, that was a joke, Neil. You're allowed to laugh.
Okay. I sensed it was a joke, but I was thinking either I'm too stupid enough to find it funny, or too smart enough to know it's not funny. So,
not all of my jokes can take off. I guess that's all right. No, but seriously though, when I was reading about this trading volume scandal, essentially it was talking about how exchanges have been inflating their trading volumes, or taking their Bitcoin and passing them between various wallets, almost like a Sybil attack, making much inflated numbers, basically making it look like much more trading is going on than actually is. And if you think about it, it's fairly easy for an exchange to do that. They would just need to have multiple wallets and transact between them, trading between Bitcoin and a stable coin, or Bitcoin and Ether, in order to appear larger. Now, when a lot of exchanges do this, the effect is that it communicates something across the industry, that Bitcoin is being traded at a high volume, that that there's reason for confidence in the market, and that the price of Bitcoin maybe is undervalued, and that everybody should buy it. That's the communication. However, it is, at least from my own personal opinion, not as an expert opinion, I didn't read this anywhere, but from my opinion, it seems unlikely, or less likely, that all of the big exchanges would be coordinating to do this grand scale inflation of the Bitcoin price. What's far more likely is the lack of oversight of a number of exchanges have caused individual exchanges to try and inflate their own prominence, to say, look, you can exchange on our exchange because there's so much volume being done here. It's a bit like when a few weeks ago I was experimenting with trying to get to turn some ether into a stable coin, and it was quite a frustrating experience because there wasn't a lot of trading volume. So I had to keep waiting for someone else to sell this stable coin so I would have enough to buy. And so I was much more likely to go to an exchange that had a high volume, so I knew I could buy the stable coin I wanted. In the same way, if you have a number of exchanges that are inflating their volume in order to appear more prominent or attract more people to trade on their exchange, well, as more and more exchanges do this, you'll have the effect of this collusion across the industry without necessarily having them collude. It's still fraud. It's still not cool. But I guess the one is sort of at the entire industry scale, and the other is a systemic failure of enforcement and incentives, causing each individual exchange or each individual company to try and make themselves puffed up compared to the others in the industry, so they can compete. Does that make sense?
It does. But all of this plays into the hands of Coinbase. Coinbase have a Coinbase Pro platform, and you're able to monitor their volumes. And out of this study that was done, they actually came out looking good in terms of not inflating their trade volume. And I know over in North America, Coinbase is seen as the main place to go trade your Bitcoin, and it just means that people like them gain from this. Because if people start questioning all of these exchanges now, well, it is in your own interest to not be gaming anything, because over time, through word of mouth or whatever, people start saying, no, use this exchange, don't use this exchange. So in a way, the industry has become self-regulatory in a way that we do need people calling BS out. We do need people, and this is the great thing about crypto in general, is that so much of it is like open source, and any programmer can go in under the hood and take all these statistics out and shed some light on them. So it goes to show it is in their interest, all of these exchanges, to be as transparent as possible, because when all of these institutional investors come in, they're going to look at Coinbase and be like, well, look, you guys are more trustworthy, and a lot of these exchanges, I don't know who they are, and I'm not going to approach them now. So it is in their interest, and I think while the industry matures, people will start to realize that trying to game the system is just a short-term gain, and will actually, in the long term, you'll probably be wiped out.
But don't forget, the smaller exchanges are more likely to engage in this sort of behavior because they've got very little to lose. If you're operating in a jurisdiction where it's unlikely that you'll go to jail, then why not inflate your volumes, get more people on, you have a short-term game, and then you run off and do something else. And this is why financial instruments and financial services companies are so heavily regulated in the first place, because there is this potential for a mismatch of the amount of information each player has. Right, like Coinbase, they have so much to lose. They're the number one player. They're in the U.S. They're very heavily scrutinized by securities regulators, by people operating in the industry. They have a lot to lose. Whereas Joe's exchange, operating out of the Grenadines, probably has a little bit less to lose and a lot more to gain.
Well, I wasn't under the impression it was mostly small-time exchanges, because if you go on Coinbase, on CoinMarketCap, and if you were to look at, say, Bitcoin or some other crypto, their trading volume, you will see that a lot of exchanges are actually excluded from the CoinMarketCap trading volume statistics because they're very unsure if this trading volume can be verified. And a lot of that trading volume that is excluded is in the millions, like hundreds of millions of dollars. So I was under the impression from the article and the different reports that were circulating regarding the story is that there are some big fish in the exchange world involved in this. But going back to jurisdiction, the point you made is that, yeah, they can get away with it. But I do feel that in the long run, it'll come back to bite them in the backside.
And it also could be that the players who are big fish now got there by methodologies like this.
Yeah, I think that's an excellent point.
You know, I mean, if you start like this, and you got to keep the lie up, essentially.
Yeah, I think that's an excellent point.
So that's not to say that it'll necessarily lead to a crypto boom or a crypto crash, but just be careful out there while you're trading. But we're fast approaching some indicators that make me a little nervous about the state of the market overall. Not just the crypto market, but generally the overall global economy.
That's right, Nathan. On Friday, something very interesting happened in financial markets. So in USA, you have the 10-year government bond and the 3-month T-bill. And what is seen as a main indicator is when the yield, that's like the percentage of rate of return you get on the bond, the yield of the 10-year US government bond actually dropped below that of the 3-month bond. And the last time that happened was in 2007, right before the financial crisis. And this is called a yield curve inversion. And this has been a very reliable indicator for, I think, the last 5, 6, 7, I think since the 1980s. All the recessions since then, this has been a very powerful indicator. So this happened for the first time on Friday. And of course, a lot of stocks and equities were sold off as a result, because people are thinking, oh, it's coming. And there has been a sense that the US market has been slowing down, and then you have a lot of global growth issues as well. So what makes this so significant in crypto terms is that we could be approaching the first recession where Bitcoin will be a part of it, because Bitcoin and crypto have only started since the financial crisis of 2007, 2008. So this would be a great opportunity to see how Bitcoin reacts. Will it get caught up in a frenzy? Because while the stock markets will not be crashing yet, it's a year after the yield curve inversion that we see a US recession and a significant correction in stocks. So the big question is going to be, will Bitcoin be resilient, or will it get caught up in the frenzy of selling? Because all havens do sell off when there's fear in markets, because people just want cash. Even if this is something people feel will be resilient in recession, everything does sell off in a significant pace. But then the likes of gold would recover quicker and then start to appreciate more over time compared to equities and other financial tools. So the big question is going to be, okay, between now and the big stock market crash, how will Bitcoin perform? And then during the crash and after the crash, it's going to be very interesting to see, will Bitcoin be resilient, or will it get caught up in the whole frenzy, the selling frenzy that will ensue?
Everyone has said historically that they would expect Bitcoin to operate similar to gold, like digital gold, as a recession-proof financial instrument. I haven't seen it, and I don't expect it, honestly. I mean, it'll be interesting, and we'll see. Maybe. I mean, there are a lot of people who are smarter than me who are analyzing this, but I guess just we haven't seen it yet. First of all, and it is treated as a risky store of value. That's the way the market has more or less been treating it, like a speculative asset, like something they're going to buy, expecting it to go up, but not something that they would long term put their retirement funds into. And I mean, we have a lot of indicators that not just the technical analysis, financial indicators. We're coming up on Brexit. And that leads to instability in the market. We've had ongoing U.S. tariffs versus Chinese products, American versus Canadian products, and so we're seeing a lot of upheaval. that has been going on over the past 2 years. And all of these indicators lead to an expected instability in the market that hasn't yet come to pass, but everyone's sort of wondering when it will be. And I don't know. I guess I just expect that Bitcoin and all of the other coins, unless they're specifically designed as being anti-recession, I don't know any of them that are designed in that way. They're likely going to be caught up just the same as any other asset.
Yeah, I believe so. I think the only way Bitcoin can, I guess, survive is if it's going through another adoption swing that we saw in 2017. Because what has been argued about crypto and why people need to have, you say, 1%, 5%, whatever crypto in their investment portfolio is that it's uncorrelated. In other words, it will go down when other equities and other financial tools are going up, and it will go up when others are going down. So it kind of gives you that alpha return in your investment portfolio. Now, the thing is that it is a risky play if you are betting that Bitcoin will outperform. But I think it is worth looking at some other indicators between now and the next few, I guess between now and the next year, to help give an indication how Bitcoin and crypto may perform. So what I thought was very interesting on Friday was that there was a huge significant sell-off after the yield curve inverted. Now, this is like a natural fear thing, so people were selling, even though the event in itself may not come for another year. But while I was watching all these stocks fall, I was following Hive. Hive is a crypto company on the Toronto Stock Exchange that is a mining company. And I was also watching Galaxy Digital, which is another crypto company on the Toronto Stock Exchange that's actually available in Frankfurt as well in Europe. It is a company that invests, it's almost like a venture capital fund that invests in crypto companies, but also does some trading at the same time. So Hive fell less than most equities, and Galaxy actually increased. So it's going to be very interesting now to watch their performance over the next few months relative to Bitcoin, crypto, but also relative to other equities on the financial markets. Because this could give us an indicator how Bitcoin and crypto could perform in a recession. So yeah, it's really, really speculative stuff. I don't think anyone has the answer, but I think some hints may emerge over the next few months.
You know what I noticed on Friday, Neil?
What?
I noticed an article in Forbes that
Go on. Yeah, please do.
That
tell
may
me.
have featured someone that we know. Did you happen to take a look?
Well, I know that I was not on Forbes, so that leaves one of two left
It was me
on this podcast.
It was very very cool. Last week was an interesting time. I spoke with a Forbes journalist about my company, Minespider, and about the prospect of using blockchain to track responsibly sourced metals. And the projects that we've got coming up, the way we've designed it, it was interesting. But when I spoke to this reporter, I didn't expect an article for maybe 6 months or something. She had told me, yeah, I'm doing some basic research. We'll see what happens. 2 days later, boom, article out. And so, no, that's a big win for me. I'm really pleased that Forbes is such a big name, and we've with Minespider, I've been pushing rather hard to make sure that we're visible, that we appear in news, doing a lot of PR. But I think Forbes is one of the biggest so far, the biggest wins.
Well, congratulations, Nathan, on behalf of the crypto blockchain community. It's a good win, and I for one, I follow Bloomberg a lot and love their crypto articles, and I love reading about all of these crypto companies I've never heard of. So often on CoinDesk, they kind of dig deep and learn about all these other companies. But if you end up on Bloomberg or Forbes, it means there's something else about you. It means that, okay, it's like you're more more trustworthy, I guess. You're less dark web, and you're I guess there's a lot of potential to your venture. So congratulations. I hope to read more articles about Minespider, but as a I know I'm your friend, but as a crypto enthusiast, it gives me a lot of hope, because this crypto winter hasn't been easy. But these type of articles go to show that the investment community are very, very hungry for more information on blockchain and its potential. And we've been saying this many times before, that investments have been very impressive in blockchain. While price action may not be great, there's still a lot of venture capitalists out there looking for prominent, trustworthy, resilient companies to invest in. And I'm sure we're going to be hearing more about Minespider in future articles in the coming months.
I'll be sure to make you all proud, and I'm sure that you will hear more about it in the coming months. But I think you're absolutely right that the enthusiasm has not died down, especially amongst the big investors and the larger corporates who are investing heavily into developing blockchain-based solutions. And it may feel like the crypto groundhog saw his shadow and we've got 6 more weeks of winter, but long term, I'm still very bullish on this technology and its potential to completely upend the way our whole society and economy work.
Very profound, Nathan. Very profound. I can't wait to read more of those quotes in future articles.
Nathan'sProfoundQuotes.com. I've got to get the URL. All right, Neil, you have a great week, and keep on hashing.
Take care, Nathan. Thank you.